and so this shall be paid out to the beneficiaries. So the beneficiaries will be paid, will receive one, the members' retirement savings, and two, an insurance benefit that is drawn from the life insurance policy taken out by every employer. So the beneficiary will only need to notify the scheme. And okay, it can be through the employer because the member is in service. So this can come through the employer. They notify the scheme of the death of the member. And then a form will be required to be filled, actually ascertaining that the member has actually died. And that is the point at which the beneficiary form will come in handy, because it's the nomination of the member that will determine how exactly their retirement, their benefits will be paid out. And in the event that the member has not filled up the beneficiary nomination form, then the trustees are allowed by law to exercise discretion and determine who will be entitled to receive that money. But I think it's neater and it's advisable for all the members to just ensure that they've filled out the beneficiary nomination form and update it on a continuous basis whenever their family composition changes, to make it easier for their benefits to be paid out to the beneficiaries, and also to ensure that their wishes are met in the event that they pass on while in service. So from there, I'll move on to the benefits that is payable under life insurance. I've already mentioned the fact that every employer is required under the PSSS Act to take out a life insurance cover for their members, and therefore the payment will be made directly to the nominated beneficiaries in the event that the member dies in service. Now, I move on to Regulation 19, and this one touches on the benefits that accrued before commencement of the PSSS Act. As we've been told, the PSSS Act, much as it was enacted in the year 2012, it came into operation in 2021. And some of the members who joined PSSS were already members of the defined benefits scheme. So under Regulation 19, we've provided that for the benefits that accrued under the Pensions Act, Chapter 189, the government shall determine the value of those benefits through an actuarial valuation, and there will be an increment rate that is proposed at the rate of 5% for those benefits, and the amount that has been computed will be communicated to each of the members concerned through what is called a letter of recognition. And those amounts will be paid out to the member upon exit from service. So once a member, exits through any of the options I had provided earlier on, then the member will be eligible to receive their accrued benefits from the DB scheme, and they'll receive the share of their contributions, the retirement savings, from the PSSS, that is the DC, the defined contributory portion. And finally, on the regulations, we have made provision for dispute resolution. Here it is recognized that disputes may arise from time to time, maybe between the members and the scheme, relating to how their contributions have been managed. And in this case, we provided that any dispute that arises shall be resolved in the first instance by the Board of Trustees. However, if a member still feels aggrieved by the decision of the Board of Trustees, then they shall have recourse to the Retirement Benefits Authority. This is in accordance with Section 46 and 48 of the Retirement Benefits Act, that provides that a member may make an application for review to the CEO of the Retirement Benefits Authority, and that can also be escalated to the RBA tribunal in case it's not settled. And any matter that is not addressed by these regulations, we've made a general provision here that they shall be dealt in accordance with the general instructions that are issued by the board. The board has broad powers. The board has discretionary powers to determine all matters relating to the scheme. And therefore, if in the event that there are gaps in these regulations, then the board should also be able to deal with those matters. But then the board cannot just exercise their discretion any manner they want, we've provided the regulations that it can only be exercised subject to the Constitution and the law. So that is all about the draft PSSS regulations. I will move on to the draft act so that once I'm done with both presentations, and we can take in questions. So you'll now allow me to share the draft PSSS bill. So just to be very clear, the regulations I've just taken you through are in respect of the PSSS Act, Chapter 189A, as currently drafted and as we are currently implementing. So the amendments that we propose, the amendments that I'm going to read out here are the ones that we're proposing to Chapter 189A to just align them to the Retirement Benefits Act and to best practice in retirement, it's also aligned to the best practice in the retirement sector. And to start us off, we have made some additions to the definition section. If you go to the PSSS Act, Chapter 189A, under Section 2, we have interpretation. We have the interpretation section where we have defined a number of terms. So the first proposal that we seek to make is to amend the definition of the administrator, because currently we've just defined administrator to mean a body corporate or a person appointed by the board under Section 35. But we've sought to broaden that definition and make it clearer that administrator means a body corporate or an employee of the fund appointed by the board as such under Section 35 of the Act. Now, so this is just in line with the provisions of the Retirement Benefits Act, which recognize that an administrator can be a body corporate or an employee of the fund, and allow me, or a natural person, and allow me to also make it clear that save for the definition of an administrator, which can mean either a body corporate or a natural person, the other service providers have to be body corporates, and that is how they've been defined. So both the fund manager and the custodian have to be body corporates. So that is where we need to draw a distinction. We have also made a provision for the term beneficiary. The Act currently does not make any definition or even provision for beneficiary, but the current trend is that a beneficiary is important in the administration of benefits. And so while the current Act currently just provides for a dependent, the dependent can only be understood in a very narrow sense. And that is why we propose to bring in the definition of a beneficiary, which is broader and includes both a dependent and any other person that may be nominated by the member in writing and who will be entitled to receive benefits from the scheme. And I keep repeating that is why it's very important for members to nominate beneficiaries, because this is actually the person, is not the dependent who receives benefit from the scheme, but it is the person who has been nominated by the member that is the beneficiary. We've also defined a deferred member, and we didn't have this provision currently. We don't have this provision currently in CAP 189A. So the deferred member here is a member who may have left the pensionable services of an employer, or that is of the public service, but has left all or part of their benefits still in PSSS. So they are also recognized as members. We've also defined an employer, because the term is currently missing in the Act, and had already mentioned who the employer is. So the TSC, the National Police Service Commission, Public Service Commission, and any other employer that the Cabinet Secretary may determine to be a public service for purposes of this Act. Next, we go to Part 2 of the Act, and this is the part at Section 3 that establishes the Public Service Superannuation Scheme. And so this does not change, but the reason that we have it here is the fact that under Section 3, we have the Public Service Superannuation Scheme established, and under Section 9, we have the Public Service Superannuation Fund established. So we have sought that we retain one term just for purposes of consistency. We retain the use of either the scheme, or the proposal was that we use either the scheme that is PSSS or PSSF. So the proposal currently is that the scheme be known as the Public Service Superannuation Scheme. However, we'll also be taking views from the members on whether we should use PSSS or PSSF, that is Public Service Superannuation Fund. So the views of the members would be important. So it's just about semantics. It's just about the term. It doesn't really it doesn't affect the root of what PSSS does. So next, under Section 5.3, we have talked about member. 5.3 talks about who a member is and at what point a member will be deemed to have left service. But that provision currently does not make provision for a deferred member. So initially it just read that any member who has retired either normally or has taken a normal retirement shall cease to be a member of the scheme. But then here, a deferred member, someone might leave, but because they've not attained retirement age, they've opted to leave their benefits with us, then that member will not cease to be a member of the scheme. They'll only cease being active members of the scheme, but they will remain as deferred members of the scheme. Next, I move to Section 6.1, and that is the provision that talks about the contribution rates. Currently, the law requires that the member contributes or the employee contributes the scheme at the rate of 7.5%. And as I said earlier, the employer matches that by making a 15% contribution. Now, here we propose that to create flexibility, this section be amended to read that every member shall contribute to the scheme at a rate not less than 7.5%. This is to create flexibility in the event that there's need to enhance the rate of contribution. The law and there's a government circular that allows that contributions should not, member contributions can go all the way up to 10%. So to have that flexibility of changing it whenever there's need, we introduce that the phrase not less than. But then there is a proviso to that increment can only be made upon consultation with the board and the members. So the members have to give a nod to it, and the board also have to give a nod before the changes can be effected. And the changes can only be effected by the cabinet secretary by a notice in the Gazette. Another provision that is very important to make here is the fact that while these contributions should be made monthly, where the employer fails to deduct these contributions, then the sum, that amount that is due within the month, shall be recovered in the subsequent month, and there shall be a penalty to that at the rate of the return that the scheme received the previous financial year. So this is just to make sure that the employer or the member does not lose out in their benefits, because any moment we receive contributions, every month we receive contributions, they are invested, they are forwarded to the fund manager for investment. So in a case where contributions are delayed, we then proposed that the amount has to be paid out the subsequent month, and the element of there's a penalty, that interest has to be paid out in addition to the monthly contribution. Next, we go to the provision of under Section 6, subsection 4, still relating to contributions. And the Act, as I mentioned earlier, currently only makes provision for the government, but does not really make provision for the employer. So here we've sought to bring out a distinction between the role of the government and the role of the employer. So the Act currently, as Section 6.4, provides that the government shall take out a life insurance policy for the members. But in our view, it's not the role of the government to take out the life insurance policy. It is the role of the employer. And that is why we propose that we delete reference to government and instead substitute that with employer, so that it's clear that it is the role of the employer to take out the life insurance policy in respect of every employee. Next, still on the distinct role between the government and the employer, under Section 7(2), we had the provision to the effect that a member shall instruct the government to deduct AVCs, additional voluntary contribution, from his monthly emoluments. But the amendment we stick to provide is that it is the role of the employer to deduct, not the role of the government. So in this case, then we're proposing that the member should instruct the employer to deduct the AVCs from his monthly pay. Still distinguishing the role of the government from that of the employer is under Section 8A, where we had indicated earlier that the government shall deduct a member's monthly contribution from the member's monthly salary. So we have proposed a deletion of that section on the basis that it's not the role of the government to deduct the member's portion of contribution. That is the role of the employer. So Section 8A then, if the proposal goes through, Section 8A will have the effect of deleting deleting the requirement for the government to deduct a member's monthly contribution from the member's earnings. And with that, we've provided clear obligations of the employer. And the first one would be that the employer deducts and remits to the scheme, of course, to the custodian, that is the member's monthly contribution, not less than 10 working days from the end of the month. And secondly, the employer shall ensure that the government's contribution is remitted in accordance with the law. So the employer's responsibility is well cut out to deduct and remit, and also ensure that the government contribution is remitted. So the government, on the other part, will deduct and remit the employer's portion to the scheme. We have then provided under what we now call Section 8C, the public service superannuation scheme fund. So this is not a legal entity. It's only a fund which shall be managed and operated by the board. And it's into this fund that contribution shall be paid, and it's out of this fund that member benefits shall be paid. So next we move. So next we see here that we've mentioned the Public Service Superannuation Scheme Board of Trustees. Initially, the Act currently provides for the Public Service Superannuation Fund Board of Trustees, but in light of the explanation that I made earlier on, that we are proposing a consistency in the use of scheme and fund. So this will be moved to Section 3, and that is why we are saying that we're proposing the repeal of Section 9. So we'll now have the Public Service Superannuation Scheme Board of Trustees, and not the Public Service Superannuation Fund Board of Trustees. But then, depending on the views that we receive from the members, if we decide to adopt fund and not scheme, then this will be the Public Service Superannuation Fund Board of Trustees. I hope that is clear. So I move on to Section 10, which brings out the composition. It establishes the Board of Trustees and indicates their composition. So under Section 10, we have proposed to have an additional 2 trustees. So currently we have 9 trustees, that is the chairman and 8 other trustees, 5 representing the employer and 3 representing the employee. Now, the proposal that we're making here is that we have 2 additional trustees, and this shall be member representatives. The reason for this is under the Retirement Benefits Act, a defined contributory scheme is required to have representatives or trustees representing members who are not less than half. of the entire board composition. So the member representative should not be less than a half of the entire member composition. But as we stand currently, the membership of the board of trustees is skewed more in favor of the employer. So the recommendation here to have 2 additional trustees will just be to ensure that we have at least an equal number of both the employer and the employees representatives, and without being in compliance with the requirement, with the Retirement Benefits Act. Next is an amendment to Section 13 about instances under which a trustee may be removed from office. And the Act has provided a number of instances, but the one we've given attention to is Section 13(2)(a), which provides that a member may be removed from being a trustee if he's been absent from 3 consecutive board meetings. So we propose to align this with the Retirement Benefits Act that requires that a member may cease being a trustee or may be removed from office if they've been absent from 2 consecutive meetings of the board. This is just to ensure that the trustees are consistently present and available to participate in the deliberations of the board. The next one is on the remuneration or the allowances paid to the trustees. That is under Section 18 of the PSSS Act. The Act currently provides that the trustees shall be paid sitting allowances at the rates approved by the Cabinet Secretary from time to time. But we've also proposed to align this to the Retirement Benefits Act, which provides that the allowances of the trustees shall be approved by the members during a properly constituted general meeting after every 3 years. So the proposal here is to pass the obligation or the authority to the members to approve trustee remuneration every 3 years in alignment with the Retirement Benefits Act. Next is under Section 20 regarding the qualifications of a CEO. So Section 20 establishes the office of the Chief Executive Officer of PSSS, and it provides for the qualifications of the CEO. Currently, the qualifications are quite narrow. That is an expert in retirement benefits, accounting, finance, insurance, or banking. So the proposal here is to widen the pool of expertise from which we can draw the CEO, and to make it open-ended. The Act currently has made it closed-ended, which may not be very ideal. So the proposal we have is that so the qualification should include economics, auditing, HR, or any other relevant field. I think what is most critical is or any other relevant field, so that no qualified person will be closed out from being appointed the CEO of PSSS. Section 16(2) proposes to bring in a very important principle of law. The fact that, so Section 16 talks about the delegation of the powers of the board, but then we have proposed a proviso here that the board shall not delegate its discretionary powers to any of its appointed agents. So this is just in keeping with the general principles of law. Next is Section 25 on the vesting of member benefits. So currently, the Act provides that benefits derived from a member's contribution shall vest immediately in the member. But the benefits that are derived from the employer's contribution can only vest in the member, say 5 years from the date of the first contribution, and only 50% will vest in that 5th year, and the rest will vest periodically up to the 10th year. And that is not in line with the law, is not in keeping with constitutional provisions on the rights of a member to retirement benefits. It's also not in keeping with the Retirement Benefits Act, which requires that all our members accrued benefits, all accrued benefits shall vest immediately in the member. So this is just to comply with the requirements of the law that all accrued benefits shall vest immediately in the member. Then Section 26 is the next one, about access to retirement benefits. Basically it relates to preservation of benefits. Currently, the law provides that a member may withdraw his contribution and accrued benefits in full on leaving employment together with AVCs. But the law on retirement benefits makes a different provision, and we seek to align our act with the Retirement Benefits Act, which currently provides that a member will be entitled to only up to 50% of all his accrued benefits. But then instead of making that instead of making it cast on stone, because the retirement benefits law also keeps changing from time to time, we proposed that then a member should be able to access accrued benefits in accordance with the Retirement Benefits Act, so that whenever the Retirement Benefits Act or changes on the access, we don't have to also amend our act. So we've just chosen to align it with the Retirement Benefits Act. Of course, we've also provided the fact that where a member is leaving the country without the intention of coming back, then they'll be entitled to all their accrued retirement savings. Section 27 and 28 relate to the access or withdrawal of benefits. So number one, we have provided for the fact that once a member has left service or has retired, then they can access their monthly pension either through an annuity purchased from the insurance company, or through an income drawdown plan. So we currently do not have provision for an income drawdown plan. We only have provision for an annuity. So this proposal seeks to bring in that aspect of access to retirement benefits through an income drawdown plan. And we have also provided under Section 23(2)(a), this is a new section for situations where a member's benefits are determined to be trivial, in which case the member may opt to receive those benefits as a lump sum. Then for a member dying in service, the current provision under Section 30 is that the administrator shall apply the entitlements of such a member under the life insurance policy. But then this is not the role of the administrator. So the proposal we seek to make here is that where a member dies in service, the board of trustees is the one to apply the accrued benefits now in favor of the beneficiaries of that deceased member. So it's just to bring in the fact that this is the role of the board and not the role of the administrator. And in this case, the benefits payable to the beneficiaries of a deceased member shall be paid out in full. So it may be accessed in full as a one-off lump sum to the beneficiaries. So that is the new provision that we're making under Section 20, under number 25 here. Now, there's another provision that we're making that is under Section 32(1) about a member. Now, the Act provides a member who was married at the date of retirement and, of course, dies in retirement. So we have proposed the deletion of this section. And the reason we have proposed the deletion is, first of all, the issue of marriage of a member does not really arise, because we are just talking about the member, and in the case of their death, we talk of their beneficiaries, and our beneficiaries do not. When we talk of beneficiaries, we don't look at whether or not the member was married at the time of death. And the reason we're also proposing deletion of this section is the fact that upon retirement, a member is already able to access. A member is already accessing their benefits either through the income drawdown or through an annuity. And earlier on, we've already provided for how the payments will be made out to their beneficiaries. So this provision in our case was superfluous because we've already made a provision for how benefits will be paid out upon the death of a member, whether active or retired. Then next, we move on to Section 33 about transfer of service. And the Act currently, under Section 33, provides that where a member transfers service within the public service or to a county government, then their retirement savings shall be maintained. But in this case, we propose that we delete the transfer, we omit transfer to a county government. The reason for this is that PSSS only handles or manages pension contributions, retirement contributions for employees drawn from the public service. So the employees of the county government already have their own pension schemes, which is also statutory in nature. And therefore, a member transferring their service to the county government will be subject then to the, or will be required to make their contribution to the pension schemes that have been established to manage the pension contributions of county government employees. Next is on the portability of benefits, that is under a new provision that we are numbering as Section 33A. And currently we don't have provisions for transfer of retirement savings to another scheme. So we are proposing to make that provision that where a member exits the public service, then they'll have the liberty to transfer their savings to another registered scheme. So they cannot withdraw it for their own use, they can only transfer it to another registered scheme. So the next section, that is on Section 35, 36, and 37, relate to our service providers. As we were earlier informed, we have 3 key service providers: the administrator, the fund manager, and the custodian. And they're engaged through a procurement process. So we propose to make amendments to the provision relating to these service providers to the effect that, number 1, their terms of appointment shall be determined by the board and set out in a written instrument. So this basically means that we should have a contract for each of the service providers that we've engaged. And secondly, that the term of each of these service providers shall not exceed 3 years and shall only be renewable subject to satisfactory performance. So this is just to make sure that all the service providers are able to perform satisfactorily and that the interests of the members are well secured. So the next is about the annual general meeting. Much as I've mentioned it earlier on as I was talking about the regulations, but it's also important to note that our Act currently does not have any provision on the annual general meeting. And so we propose here to introduce this new section as Section 38A, that the board shall convene an annual general meeting within 6 months from the end of every financial year. And we shall convene and conduct these general meetings in accordance with the provisions of the Retirement Benefits Act. The Retirement Benefits Act has specified in great detail how an annual general meeting shall be held, what the agenda shall be, and the notice period that should be given for the AGM. So we propose to adhere to the provisions of RBA when it comes to convening and conducting an annual general meeting. The next one regards the administrative expenses of the scheme. And we are proposing that we make this provision that the board shall meet all the administrative expenses of the scheme from the scheme fund. We earlier mentioned the Public Service Superannuation Scheme Fund that will be managed by the Board of Trustees. And in this case, the proposal is that this administrative expenses of PSSS shall be met out of that fund. And the administrative expenses shall not exceed 2% of the total scheme assets. But this amount will even reduce further from the 6th year to 1.5%. So this is just to ensure that we minimize the amounts we spend on administrative expenses. And the board is also given the authority to open an account from which these administrative expenses shall be defrayed. So moving on, under Section 40 currently, the Act provides that the board may invest surplus funds established in the accounts established by the board in securities approved by the Cabinet Secretary. And so we are proposing that this provision be deleted for the reason that the trustees have absolute authority to determine how scheme funds will be invested. And secondly, the Retirement Benefits Authority has provided very clear guidelines on how scheme funds should be invested. And so since we have those two key provisions, the Board of Trustees guided by the investment policy statement, and of course the oversight of the Retirement Benefits Authority, the Cabinet Secretary does not really have a role in determining how scheme funds may be invested. And that is why we are proposing deletion of that provision. Next is on the reserve account, where we currently have provided that there shall be maintained a reserve account into which shall be deposited various funds here that we've set or that we've listed. But the key phrase that we are noting here is the fact that there shall be maintained is vague, and it should be made clear that it is the responsibility of the board to maintain this reserve account. So instead of saying there shall be maintained a reserve account, we propose then to change it to read the board may maintain a reserve account to clearly apportion responsibility to the board. Next is a provision on the annual estimates. Of course, we've said that we replace scheme with fund, but as I said, we'll also take the views of the members on whether we can retain fund and not scheme. So here about the annual estimates or the annual budget, we said that this should be prepared at least 3 months before the commencement of the financial year. And we have provided the items that should be contained in the budget. That is, for example, the payment of the board and other operational expenses, payment of pension and gratuities for staff, maintenance of buildings, and even repairs and replacements of equipment. And so that just makes it very clear that we do not just spend out of no basis. There has to be a basis for our spending, and that should be captured in the annual budget. And next is the fact that the books of accounts of PSSS have to be kept. It is the responsibility of the board to make sure that the books are kept and that the records are proper. And for that reason, the board is required to cause these accounts to be audited. So currently, the requirement is that these books of accounts be audited by the Auditor General in accordance with the Public Audit Act. We are proposing that these accounts be audited not just by the Auditor General, but the trustees be given the liberty to also appoint an auditor and to appoint an external auditor. The reason for this proposal is the fact that the scheme under the Retirement Benefits Authority, the scheme has very tight timelines as to when the books of accounts should be audited and submitted to the authority. We actually have 3 months. Only it should be prepared, audited, and submitted to the Retirement Benefits Authority within 3 months from the end of the financial year. And most of the times, because of the fact that the Auditor General runs on a schedule, the scheme may find itself in a situation where it's not able to comply with the timeline set by the regulator. So in that case, we're proposing that the trustees be given the liberty to also appoint to engage external auditors, of course, competitively through the procurement process. And the good thing about this is that the Retirement Benefits Authority also supervises the appointment of auditors, and they will have to approve the auditor appointed by the scheme. So that just makes it, so that just ensures that the auditors appointed by the board shall be above board and have been vetted and approved by the Retirement Benefits Authority. And as a scheme, we'll also be able to meet the tight timelines that have been set by the regulator in submission for submission of the annual of the audited accounts. Next is on Section 45 of the PSSS Act, that is on actuarial valuation of the fund. The Act currently provides that we conduct an actuarial valuation of the fund periodically. However, we've proposed that this provision be deleted. Reason being that from the retirement benefits perspective, actuarial valuation is mandatory for defined benefits schemes. However, for defined contributory schemes like PSSS, that is not a mandatory requirement. It is not a necessary thing to do because the member contributions are well known. We know of the 7.5 employee portion, the 15% employer portion, and the fact that the interest will be credited to the member's account on an annual basis. So since that amount due to a member in the DC scheme is very well defined, then there will be no need for an actuarial valuation. And mostly actuarial valuation in the DB scheme is usually also meant to determine the funding level of the scheme. So in this case, that funding level is not really a requirement for the DC schemes. And that is why we're saying that this will be an unnecessary activity and it will also occasion an unnecessary expense to the scheme. Next, I go on to the provision under Section 49 of the Act regarding circumstances under which, again, a person, maybe a trustee or an employee, may be removed from or may cease being one. And here, the provision was that where an employee or a trustee is convicted of an offense, then the minister, that is the cabinet secretary, may cause that person to be removed. However, in our view, it should not be upon the cabinet secretary to determine the removal of that officer or that trustee. Instead, it should be automatic that once a person has been convicted of an offense and they've been taken through the criminal trial process and found guilty, then the person shall automatically cease to be a member. If it's a trustee, then that person shall automatically cease to be a trustee. It should not depend on the decision of the cabinet secretary. Next is on Section 50. This section relates to benefits that accrued before commencement of the PSSS Act. I mentioned this when I was talking about the regulations. And so just as a recap, I will just mention the fact that the proposal we're seeking to make here is to bring clarity, because at the moment, Section 50 is not really clear on what becomes on the contribution and whose responsibility it is to pay out these accrued benefits. So we seek to bring clarity to that provision. First of all, by saying that all benefits that accrued before commencement of the PSSS Act, whether they accrued by virtue of the Pensions Act, Chapter 189, or the Widows and Children's Act, that is a Cap 195, then shall accrue and shall be payable under those respective acts. So any benefits accruing under Cap 189 shall be payable in Cap 189. Benefits accruing under the Widows and Children's Pension Scheme shall be payable under the Children's under Cap 195. And of course, benefits that shall have accrued under the PSSS Act shall also be payable under the PSSS Act. But then just for clarity on the way forward, so all those benefits that are accrued under the Cap 189 shall be, the government shall have a role in making sure that they are determined, and through a letter of recognition, the members will be notified of the amounts or of the benefits that are due to them. And we're proposing that the government shall issue these letters of recognition within 6 months from the date of commencement of this act. And so those benefits, after they've been determined and recognized in a letter, shall not be payable immediately. They'll be deferred until the member attains the retirement age. They can only be paid out if a member dies in service. Next is a general provision relating to compliance with the provisions of this Act, we recognize the fact that because of circumstances beyond anyone's control, the fund or the Board of Trustees might not be able to discharge or to implement some of the provisions of this Act. And this therefore gives the Cabinet Secretary, with the concurrence of the Retirement Benefits authority to exempt the trustees from complying with those specific provisions, or to even extend the times. So assuming, for example, timelines of 3 months or 6 months have been provided for accomplishment of a certain task, then the CS, with the concurrence of RBA, will also have authority to allow to extend the time required for compliance. And just a case in point or just trying to paint this scenario and make it clearer, is that during the COVID season, schemes were not able to have their accounts audited and submitted to RBA within 3 months. Schemes were also not able to hold AGMs, and boards were also not able. Trustees are required to meet on a quarterly basis, but in this instance, they were not able to meet because of the circumstances arising at that point. And RBA issued guidelines on how exactly the members of schemes were expected to conduct business at that point. And in fact, times were extended. The times for holding annual general meetings were extended. Some schemes were even exempted from making member contributions until such a time that they stabilize. So to cover for such instances, we propose to bring in this new act of exemption of the board and extension of time. Next is exemptions from the Unclaimed Financial Assets Act. And here we propose that the Unclaimed Financial Assets Act shall not apply to the scheme. The provision that we were more keen about is the requirement that any unclaimed benefit shall be transferred to UFA if any benefits remain unclaimed for a period of 2 years, then it is incumbent upon the trustees to transfer them to UFA. So in this case, we're proposing that instead of transferring them to UFA, that those amounts should remain in the scheme, they continue being invested by the trustees, because as trustees, they have a fiduciary role, and they'll actually ensure the safekeeping of these finances until such a time that the members or their beneficiaries come to claim it. So we feel that the money is safe with the trustees, and therefore the provisions of Unclaimed Financial Assets Act should not apply to PSSS. Then we've also proposed a transitional provision, mainly because we have, if you can recall, we proposed a change in the composition of the Board of Trustees. And the proposal here is that these changes, in the event that these amendments go through immediately, then the members currently serving should not be affected by the changes until the end of their term. So they should be able to serve until they complete their respective terms. Then finally, we have proposed an amendment to the State Corporations Act, because currently PSSS is established by an Act of Parliament, and by virtue of that, we are a state corporation. However, at the same time, being a retirement scheme, benefit scheme, we are subject to the provisions of the Retirement Benefits Act. And in most instances as a scheme, we found ourselves in a situation where the two acts are conflicting, and we are not able to fully comply, or we are not certain which one we should comply with and which one we should not, we should leave out. So we propose then that to bring clarity and to ensure that we are always fully compliant, then we should align ourselves with the provisions of the Retirement Benefits Act, since we are a retirement benefits scheme. So in that case, that we propose that the State Corporations Act shall not apply to the Public Service Superannuation Scheme. So those are the amendments that we're proposing to make, and I think I'll hand over to the moderator to take up your comments and your questions and your requests for clarifications. Thank you so much for your time and for listening to me.
Thank you, Angela, for that detailed presentation on the regulations. and the amendment bill. So at this point, ladies and gentlemen, we are going to take contributions from the membership in the form of questions or comments on what has been proposed in the two documents. So I'd request that you, for any members who have comments or questions, to raise their hand so that we can usher you to ask your question or make your contribution. We are also receiving questions through the chat, so at some point I'll invite Douglas Asanyo to also guide us in answering those questions. So members, if you have questions or contributions, please raise your hand so that we can usher you to ask those questions. If you have any questions, you could as well unmute your mic and proceed. So as we wait for that, Douglas, are you with us? We can take a few
Yes, I am.
questions based on the chat. There's a question from Atito Japheth, who asks, at what point will the government write this letter? So Atito is asking, at what point will the government write the letters as proposed in the amendments? Douglas,
What we've provided for is that upon commencement, after now the amendments have gone through, the government will have 6 months to finalize that and issue those recognition letters to members who transited from the non-contributory scheme to PSSS.
Thank you, Douglas. Martha Nyambura asks, how long does it take for one to access the fund after retirement? So Martha, your retirement benefits will be paid to you within 30 days after retirement. We're taking questions. So there's a question that was raised by Washera Minor, which Douglas has addressed, but I would want you to also address it in the main forum for the benefit of others. So she asked, for those who are under the national scheme, but got devolved to counties. Now they are either in lab fund or lab trust. Explain that so that, and on whether they are still members of PSSS.
Thank you, Njoroge, for that. When the scheme PSSS was commencing, a circular by the head of public service was issued, and it communicated who is going to be a member of this scheme. And the county government's employee who were initially employed by national government under the Public Service Commission, but their services were transferred to the county governments due to devolution, then are still members of PSSS. That is why for those who didn't join the PSSS and had services transferred, their benefits are still paid by the National Treasury for those who are above 45 and didn't join the scheme. So they are still members of PSSS.
Thank you, Douglas. There's a question again by Martha. This is on the investment income. She asked what happens to the gains made by the fund. Do they trickle down to the member?
Thank you, Njoroge. For the benefit of everyone, once investments are done and the auditor has audited the financial books, an income is the return on investment is pronounced by the Board of Trustees, and that income is distributed to each member to their to their respective retirement savings account each financial year. So once we declare, we make sure that that is distributed through all the members' retirement savings accounts.
Thank you, Douglas. We have Christine. Christine, proceed and ask your question or comment. Christine? Christine, please unmute your mic and proceed.
Oh, yes. I hope I'm audible enough. I'm
Yes, you
asking
are.
two questions. One, there's the form that was supposed to be filled by members who are out, who joined the scheme. Like we started getting deductions from our pay slips without knowing, but now we know it's about the PSSS fund. So where can we get the forms? How can we fill them? And that is the first question. The second question, I'm calling to ask about those who are working with the national government before devolution and had not done 10 years with the national government. I've seen the question being addressed quite well with Mr. Senyo. I hope I'm pronouncing the name right. But again, upon inquiring, maybe we need an indulgence also from the RBA, because there was that information that those who had not completed 10 years had not yet been included in the whatever that contributory fund. Sorry, I hope you understand my question. So, how can individuals, like, how can people know within those who had not completed 10 years before joining the scheme, I mean, before devolution, do they have anything, and how do we go about it? Because there's that gray area that has not yet been addressed fully. Thank you.
Thank you, Christine. Douglas, would you want to address that and maybe also talk about the different forms that are available to members and where they can access those forms?
Thank you. The forms of the scheme can be downloaded from the download section of the PSSS website, www.psss.go.ke. You will get all those forms there, from the beneficiary nomination form, additional voluntary contribution form, and even the benefits claim form. So whenever you need services from the scheme, in those manner, you can always download the forms and complete and submit them through your employer. And on eligibility to pension, yes, it is 10 years, but it's 10 years service, but not service to the scheme. What the law provides, as long as you are still within the public service, if you served under the public service administered now in the non-contributory pension scheme administered under the Pensions Act Cap 189, and you are still in the services of your employer, that is the public sector, then that period is still cumulative. It's about the pensionable period. If you are still in service, that will also count for you to be pensionable. Even if you served 2 years in the old scheme and then PSSS happened, you are still eligible for the accrued benefits from the non-contributory scheme.
Thank you, Douglas. I think as part of that response to Christine, her question was particular to the member enrollment form. She says that she was automatically enrolled to the scheme in 2021. She didn't fill in any form. Douglas, she didn't fill any form. Can she fill in the member enrollment form at this point, 3 years into the scheme?
We had two categories of members or employees joining PSSS. Those who were below 45 years of age, as at 1st January 2021, became automatic members by commencement of the Act. Those who were above 45 had an option to complete an option form to join PSSS and start contributing. And once a member joins the PSSS, then they cease being members of the non-contributory scheme. So for those who are below 45, at that time, they were not required to complete any form because the Act didn't specify. But now that members are already on board and we're requesting them to nominate beneficiaries, we have a form. It's called Enrollment and Beneficiary Nomination Form. So that takes care of that. So those who are below 45 happened to be members because of the Act. There was no choice. The choice was only for those who are above 45 years of age as at 1st January 2021.
Thank you, Douglas. There's James Ogweno. is asking on the chat, can a member be allowed to contribute more than the normal contribution of 7.5% of their basic salary? Maybe talk about the additional voluntary contributions, Douglas, in the context of the circular issued by the National Treasury in July on the registration and management of public service retirement benefit scheme, particularly on the contributions by the employer and the employee.
Yes, a member is allowed to boost their savings towards retirement by doing additional voluntary contributions. That is done by a member downloading a form, completing it, and submitting it to their employer, who will, in effect, deduct those additional voluntary contributions and forward or remit to the scheme. These additional voluntary contributions are only deducted from the member as they wish, not as a percentage, but an absolute figure. And as Angela said, these amounts can be increased, decreased, or actually even stopped when a member is unable to continue with that. What I want to insist on is that whenever a member is doing additional voluntary contributions, the employer is not obligated or will not match those contributions. This is individual and it's for purposes of improving or boosting retirement savings for that particular member. The Treasury Circular that was issued on 10th July 2024 only talks of the limits of contributions for the schemes, pension schemes, with a minimum of 6% to 10% for the employee and 12% to 20% for the employers. I hope that is clear.
Yes, thank you. Thank you, Douglas. Chepkwani asks, what will happen to their deductions? I think this is on the issue of non-remittance. What will happen to deductions done on member payslip but not remitted to the scheme by the employer? His question is, he says that, for instance, he has around 10 months that were affected but were not reflected in their statement. Maybe Chepkwani, because that seems to be a personal issue, could you write to us on email info@pssf.go.ke to allow us to confirm the discrepancy in your statements and advise further. But Douglas, could you talk about issues of remittances and where we are, and how does the scheme handle the issue of non-remittance?
As per the Act, employers are obligated. They have the obligations of ensuring that they deduct the members, the pension contribution from members, and remit to the scheme by the 10th day of the subsequent month. So, and then the National Treasury will do the 15% for the employer contribution, which is also remitted to the scheme, and it has been up to date. For the employers who fail to remit, the scheme tries to reconcile the accounts and also follow up with the employers who have either deducted and not remitted to the scheme so that there are no delays. And where delays are, employers are always requested to remit the delayed remittances with the interest as prescribed in the PSSS Act.
Thank you. Thank you, Douglas. How do I access my statement? That is Eric Omondi Okech. Eric, you can access your statement through the member portal. So you can access the member portal via www.members.psss.or.ke. So when you log into that portal, you have an option of seeing your contribution statement, and you can also get detailed statements, audited statements for the financial years 2022 and 2023 that also indicates your investment income, the investment income that you gained during that period. Thank you, members. I see we are joined by our CEO, Dr. Jonah Ayabei. I'll allow him to also make some remarks at this point. Asante, karibu daktari. Daktari, can you hear us? Thank you. Thank you. Seems the CEO is having some technical challenge, but he'll join us and make some remarks before the end of the meeting. So we'll share the link with you, David, www.members.psss.or.ke. That is the member portal that you can use to download your statements as we have indicated. So Martha is asking, is it possible for a member to be getting the statements of his or her account? Martha, as we indicated, you can get your statement on the member portal. Thank you, members. At this point, I'll invite our CEO, Dr. Jonah Ayabei, who is on the line, to make some remarks and some final remarks as we end this virtual public participation forum. Daktari, please unmute your mic.
Unmute. Hello?
Hello.
Joroke, I'm not very sure whether you can hear me.
Yes, we can hear you, Daktari. Proceed.
Okay. Good afternoon, everyone. Good afternoon, members who have managed to join. Mine is to really appreciate the feedback that is coming forth during this very important exercise for Public Service Valuation Act. We have come back to you to really get your comments on how the legal provisions that are being amended will be fitting to the necessary requirements or expectation of all the members of the public. So I really want to appreciate all of you who managed to join and appreciate the team who have been coordinating this. And we want to wish you all well and let you know that this is really our scheme. And we want that we get it right in terms of the amendments to the benefit of each and every member. We do exist to serve the members, and in everything that we work around is to really add value to the members. So thank you very much, all of you. I wish you well in this afternoon and in your other endeavors. God bless.
Asante sana, CEO. Members, at this point, we've come to the end of this virtual public participation forum. We would want you to take note that you can always engage us through the various options that we have shared on the screen. We are available on call. You can always call the office via the number 0746 111 777. You can write to us on email info@pssf.go.ke. And you can also access our website on that link, psss.go.ke. So you'll get all information that you need on the scheme on that website. You can also write to us on WhatsApp for a more personalized engagement through the number 0783 111 777. In conclusion, just to mention that we are still receiving your contributions on these two documents via email. As had been shared earlier, it's public participation at pssf.go.ke. Asanteni sana, members, ladies and gentlemen, for that engaging session. We wish you a wonderful afternoon, and may God bless you.